if you like salacious, if you like something with an edge, if you like scandal, that's what today's episode is about. You just can't make this stuff up, can you? All of the absolute ridiculousness and craziness that goes on, all of the corruption, all of the bad behavior in our government, it is really shameful. If you live in the US or you've been keeping track of our news, you know the big story that broke about the sexual escapades right in the place of government. It's absolutely unbelievable. But this is nothing new. This is nothing new in Washington, D.C. These people are living on our money, whether it be our taxpayer money or the debasement of our savings, stocks, bonds, and investments through inflation. Either way, it's our money, right? They are extracting wealth from us and living the life of rock stars. Now, there's nothing wrong with being a rock star, I guess, if that's your thing, but at least a rock star is not funded by the citizens, right? They might live a crazy partying lifestyle, but we don't fund them unless we're buying their concert tickets and their music, which, hey, we probably are, but that's by choice, right? Government is not by choice. And you look at the absolute corruption. You look at like Nancy Pelosi. What a great example, right? She beat every hedge fund. I mean, Nancy Pelosi is the world's best investor. No question about it. She should be hosting this show, not me, because her returns are upwards of 60% annually on her portfolio. We do pretty well with income property, the most historically proven asset class in the entire world. But 60%, we do get that sometimes. We even exceed that sometimes, but not consistently, right? So yeah, there we go. Anyway, let's get to some real estate stuff. So the good news is the powers that be are reducing the mortgage rates, and the market has already reacted, but the Fed has signaled that mortgage rates will drop pretty significantly into the new year. And what does that mean? That means a whole bunch of people that have been priced out of the market that couldn't afford to buy after these interest rate hikes we've had will now be able to afford to buy. And that affordability is coming into an extremely low inventory housing market with inventory that is approximately half of what it needs to be considered normal. That's just normal. Inventory needs to double to be normal. My prediction is this is going to light the market on fire, where we are going to see much more upward pressure on prices. Look, everybody got it wrong. I was right. The last several years, well, I've been right for decades, but the last several years, and I'm going easily back to 2015, everybody said, the market is going to crash. It's over. It's been going too long, coming out of the Great Recession. And they were definitely singing that tune in 2016. They were definitely saying it in 17, 18, and 19 for sure. And for sure, they were saying the end of the world was happening when the COVID era hit, and the complete opposite happened. Then they were all predicting a market crash when the rate hikes occurred. And I guess they don't understand the most basic law of economics, supply and demand, because they simply looked at housing affordability for new buyers, and there are hardly any of those people because the market has been much slower. Only about 5 million people have been affected by the higher rates. But wait, that's actually wrong, because about 40% of the people that have been buying have been cash deals. So they're not even affected by the rates, right? So, okay, just under 3 million people, and many of them, about a third of those, probably investors, or a little less than a third now, investors, right? And many of them new home buyers with buy downs on their mortgages. I mean, these higher rates haven't really affected that many people. Remember, I'm comparing this to about 140 million housing units in the United States. Now, let's get back to the rates declining. We're going to experience massively increased housing affordability I know. Compared to what? Well, it's definitely not as good as it was during the COVID era, but it's increasing significantly compared to what it's been the last year and a half. And we're doing that into a market that is extremely inventory constricted. We've had appreciation the last year and a half when most people predicted depreciation. What happens when you lower the rates and affordability increases? You take another cut, another cut, another cut. And what I mean is not a cut in rates, but a cut at the unaffordability problem, the housing affordability problem. You keep chipping away at that and housing becomes more affordable, right? That's exactly what's happening. It's already happened just on words, not actions. Wait till the actions kick in and we see increased affordability in a low inventory market. Folks, this is simple supply and demand. There is nothing exciting here. I don't have to talk to you about complex stuff. I don't have to talk to you about the repo market or the yield curve. Nobody cares about that. What they care about is their plans, their goals, their dreams, and how much house can I afford to buy? We've got massive shadow demand, we've got low inventory, and now we've got increasing affordability in a market that has already been appreciating with declining, massively declining affordability. What happens when affordability increases? Folks, just do the math. This is quite simple. All right, let's look at the forecast here. Mortgage rates next year. Currently, the Mortgage Bankers Association, otherwise known as the MBA, is forecasting a baseline mortgage rate ending next year at 6.1% and reaching 5.5% at the end of the following year. Now, what have I been telling you, even though I suck at predicting interest rates? I have been predicting that mortgage rates would settle in the fives. Maybe I'll be right. Maybe I'll be wrong. Who knows? Of all my great predictions, and there have been many, most of them have come true. The one that hasn't is interest rates. I've been pretty bad on the interest rate predictions. So this is not my prediction, it's their prediction. But it was mine too. I've been saying that for a while, 5% range. Okay, as treasury rates decline and the spread narrows. Now, we're going to look at the spread between the Fed rate and mortgage rates on a future episode. I got some good data on that, some good charts on that. So look for that in an upcoming episode, okay? Now, what is NAR forecasting? National Association of Realtors, largest trade lobby organization in the world, 1.6 million members. Recently, they've come into some trouble with that big lawsuit. We've talked about that. But anyway, they're pretty good at doing forecasts, right? NAR's got a big research division. They've been doing this for decades. And I got to give them credit. They're pretty good at their research. So they're forecasting a 30-year fixed rate mortgages at 6.3%. It is possible we will see mortgage rates in the high 5% range, but it is very unlikely that we'll see 30-year rates in the 3.5% to 5% range as we saw for over a decade, right? So I agree with that. We're not going to see those COVID era rates again unless we have another big crisis. But the Fed has probably achieved their soft landing pretty well. And guess what else? Remember how when rates were so low and money was free, we talked about how they had to reload the gun? Okay, they've done that. The Fed is now reloaded. They are ready for the next crisis because now rates are way up. And when the next crisis occurs, they can act again with easing the money supply, with helicopter money, with QE. They've reloaded. Okay, folks? Yeah, another crisis will come. You can be sure of that. There will be another crisis. There will be war. There will be pandemics. There will be global warming, whatever. There's always going to be a crisis. There's always going to be a crisis. But now they've reloaded. They've restocked the shelves. And now they have the weapon, the tool to fight the crisis, the next crisis. So I don't know. I was thinking Jerome Powell kind of overdid it. He probably did. He probably overcorrected. And I've been critical of him. But whatever. The past is the past. We have what we have, and we are where we are. And right now, the Fed is kind of looking pretty good. I got to give them some credit. Little too much pain for a year and a half, overreacted, overcorrected. But now, look, prices didn't even go down. They went up during this overcorrection time. So you just take it for what it's worth, the future, right? Anyway, let's talk about the absolute disgusting perils in Washington, D.C. Folks, these are the people you are paying to run our government, and their escapades are just insane. But I got to tell you, the one thing we need to solve this problem more than any other is term limits. We got to have term limits. Everybody looks at the president and they think, the president does that and the other thing, right? Sure. That's only 4 to 8 years. We have got to end this idea of career politicians. Nobody should be a politician as a career. A politician should be something you do for a short period of time. You leave your business, you leave your district, you come and you serve, and then you go, right? We need term limits. We need term limits. The other thing is most people, both on the left and the right, will agree that government is bloated, corrupt, and inefficient. Less so on the left, right? But definitely the people on the right and the libertarian side, they will agree with that. Well, look, if there is corruption in government, one way to fight corruption is it will expand and contract with the size of government. So make government smaller and the corruption will be smaller, right? Simple prescription for that.